Welcome to today's deep dive, and we are starting with a story that touches every coffee cup in America. Arabica coffee futures have surged to record highs after President Trump withdrew threatened tariffs and economic sanctions against Colombia, the world's second-largest Arabica producer. That policy reversal removes what traders had been pricing as a major supply chain disruption, one that could have cut off approximately 13% of global Arabica supply. The geopolitical whipsaw drove prices to historic levels before the reversal, and now markets are recalibrating what a normalized Colombian export flow means for U.S. importers, retailers, and inflation expectations broadly. The Trump administration had been signaling tariffs consistent with its 25% precedent on Colombian goods, a binary policy threat rather than a gradual escalation. That threat alone was sufficient to send Arabica futures to all-time record highs, as traders front-ran what would have been a catastrophic supply shock. When the administration reversed course and withdrew both the tariffs and economic sanctions, the acute spike risk dissipated, but prices remain at record levels because the underlying fundamental supply picture in global Arabica markets is already tight independent of the geopolitical overlay. This is a two-layer story, policy risk removed, but structural tightness intact. Arabica is the premium grade bean used by Starbucks, specialty roasters, and high-margin packaged coffee brands. It is not interchangeable with cheaper Robusta on short notice. When Arabica prices hit records, the cost pressure transmits directly into consumer prices with a lag measured in quarters as roasters burn through contracted inventory. That pipeline effect means even with the tariff threat removed, U.S. coffee inflation is not immediately reversing. For the Federal Reserve, persistent coffee and food commodity inflation at a time when the 10-year Treasury yield is already sitting at 4.70% complicates the rate cut narrative and keeps the policy path uncertain heading into fall. The clearest beneficiary of the tariff reversal is Starbucks. Starbucks sources heavily from Colombian Arabica growing regions, and input cost relief directly protects its margin structure at a time the company is already managing traffic and pricing pressures. McCormick carries meaningful coffee segment exposure through its flavor and extract businesses, making it another direct beneficiary. Coca-Cola and Pepsi both have coffee-adjacent segments, Costa Coffee for Coca-Cola and premium beverage extensions for PepsiCo, where Arabica cost relief matters at the margin. On the flip side, the geopolitical de-escalation reduces safe haven demand, which is a mild headwind for gold near 4,450 and potentially eases upward yield pressure. The single most important signal to monitor is whether the Trump administration holds this reversal or reimposes tariffs. The administration's track record on Colombia policy introduces genuine binary re-escalation risk. On the market side, gold is trading near the psychologically significant 4,450 level. A sustained break above that signals risk-off sentiment is reasserting itself despite the diplomatic resolution. The VIX at 15.72 is the loudest warning in today's tape. Large-cap equities are trading with modest weakness, but that the VIX level says options markets are hedging for something beyond the coffee story. Watch Colombian government statements on export confirmations as the next concrete catalyst. The Trump tariff reversal on Colombia is a genuine near-term positive for consumer staples. Starbucks, McCormick, and Coca-Cola and Pepsi all benefit from Arabica input cost stabilization, and U.S. coffee inflation risk is meaningfully reduced if the policy holds. But the VIX at 15.72 tells you institutional traders are not fully buying the de-escalation narrative. They are buying protection. With the 10-year yield at 4.70%, gold near 4,450, and large-cap indexes slightly in the red, the market posture is cautious optimism at best. Own the consumer staples relief trade, but maintain hedges because policy reversals in this environment can come within a news cycle. That is the one story that matters today. Full breakdown is above. If you want this level of depth every single trading day, specific tickers, real levels, macro context, hit subscribe right now and turn on the notification bell so you never miss a session. We break down what actually moves markets, not just the headlines. See you tomorrow.